Hello, I'm Dr. Cheryl Dunn, and I'm here to demonstrate an intermediate financial accounting problem for a fictitious company called Wildcat Lakers, Inc. And this company accepted a note receivable in exchange for selling some merchandise. This company normally doesn't offer credit terms on its sale, but for this customer they decided to make an exception. And they accepted a notes receivable for $500,000. We're going to use a note receivable of two different lengths to demonstrate the time value of money as it relates to this sale. Because the sale can't be recorded for the entire amount of the note because of the fact that we're not receiving the note for either 6 months down the road, or the second scenario we'll look at is 3 years down the road. So take a look at the problem. Pause the video for as long as you need to read it. You'll notice that I divided my board into two sections. The first section is much smaller because when we have a 6-month note, we don't have nearly as many entries to make. The bigger section is going to be for when we regard the note as a 3-year note, because we have a few more journal entries to make in that case. So under the first scenario, the note receivable is for $500,000. We need to figure out what portion of that is interest, because even though it's a non-interest bearing note, we still have to regard it as having interest implicit in the note. And given that similar borrowings would bear interest at 6%, we're going to use the 6% rate as the amount of interest that is implicit in the note. Since this is only a 6-month note, though, we wouldn't take the full 6%, but rather we would adjust it for 6 months out of 12, with 12 months being the number of months in a year, so that's what we use to convert that annual rate into just a 6-month rate. That amount, when we multiply it out, is $15,000. So we are going to regard $15,000 of this note as interest revenue that we earn instead of sales revenue that we're earning on the products that we're selling. First of all, on January 1st, when we receive the note from the customer, we're going to debit notes receivable, which is an asset, and that will be debited for the face value of $500,000. We then will credit a discount on notes receivable for the amount of interest that will be earned over time. The discount on notes receivable is a contra asset, and so it takes away from the note receivable. And if we were looking just at the note receivable all by itself, we would say that it has a book value of $485,000. That happens to also be the amount of sales revenue that we will earn because we base the sales revenue on the present value of this note receivable. And so we're going to recognize the sales revenue for the $485,000 present value of this note receivable. Then on July 1st, assuming that the customer pays us as scheduled, we would then debit cash for the amount of $500,000 that they would be paying us. We would then debit the discount on the note, because now we're going to convert it into interest revenue because we would have earned that now. So we're going to take it out of the discount and put it into interest revenue. And we increase revenues, of course, by crediting them. So we're crediting the interest revenue for $15,000, and then we need to credit the note receivable itself because we will no longer have that asset, because we don't have the right to receive something once somebody has already paid us. So these are the entries that we would make if this was a 6-month note. Notice that the accounting period in this company was a calendar year as their fiscal year, so they didn't have to make any financial statements until December 31st, and so all of the course of this note happened before they had to make any financial statements for the year. So we didn't have to worry about adjusting entries or any of that stuff. In this second scenario, we're going to assume this is a 3-year note, and so we're going to have to make some adjusting entries when we get to December 31st each year. So the first thing we're going to do is we're going to calculate the present value of this note if it is a 3-year note instead of a 6-month note. Our formula is a little bit more complicated. We can't use the same formula that we used over there if it's a 3-year difference, because we have to use the time value of money tables to get the amount that we need for that 3-year period. So we're going to take the $500,000 and we're going to multiply it by the present value of a dollar factor using the interest rate of 6% and the time period of 3. If we find the factor in that table, take a minute to look at that. We find that that factor is 0.83962. And if we multiply that times the 500,000, that gives us the present value of this note as $419,810. That means that our initial discount is the difference between these, so 500,000 minus 419,810 gives us a discount initially of 80,190. Over the life of this note, we're going to be recognizing that 80,190 as interest revenue, but we won't do it all at once. We'll do it over the course of time to reflect that time value of money. When we initially receive the note on January 1st, we will make a similar entry to what we made over here, but using the new discount amount. So we're still going to debit notes receivable for the 500,000 face value, but this time we're going to credit the discount on note receivable for the 80,190, and we're going to credit sales revenue for the present value of $419,810. Then when we get to December 31st, now we've reached the end of an accounting period and we need to make financial statements. So even though the course of this note is not finished, we need to recognize part of the interest revenue even though we're not receiving it yet. And so what we're going to do is we're going to convert part of this discount from the discount into interest revenue. To do that, we're going to calculate the present value, the $419,810, times 6% interest. That's the amount that we will assume that we earned in that first year. So we're taking the book value of the note, which started out at the $419,810, and multiplying it by 6%. That gives us $25,189. And so then we're going to debit the discount for that amount and credit interest revenue for that same amount. Now, what happens once we've debited this discount is notice that the present value or the book value of this note now changes. And so now the book value of this note is the $500,000 minus the $80,190 plus the $25,189. This gives us $444,999 as the book value of the note at the end of 1 year. In the second year, then this is the amount that we're going to base our interest calculation on. So we'll multiply that amount times 6%, and that's going to give us $26,700. So this was December 31st of the first year. Now on December 31st of the second year, we would debit the discount for $26,700 and credit interest revenue for that same amount. Then our present value or book value of the note increases by that $26,700. And so on December 31st of year 3, two things are going to happen. One, we're going to collect the cash. And two, we're going to recognize the rest of the interest revenue that we have earned. So when we receive the cash, we're going to debit cash for $500,000. We're also then going to credit the note receivable for that $500,000 because we can't have that asset on our books anymore if they've already paid us. They don't owe it anymore. Then we're going to debit the discount for the amount that remains in it. And so if we take the original $80,190 and subtract the $25,189 and subtract the $26,700, we see that the remaining amount that still needs to be taken off is $28,301. That then is also the amount of interest that we earn in that third year. And so we'll credit interest revenue for that amount. So you can see that when we have a 3-year note as opposed to a 6-month note, the journal entries are much more complicated, and we have to realize that the time value of money had a much bigger effect when the time is longer. And that should make sense because we're looking at the time value of money, so the longer the time is, the more value is taken away from the sales revenue. That concludes this demonstration of Wildcat Lakers, Inc. Thank you for viewing and have a wonderful day.